Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Thursday, everybody. This is quite a big episode. We have a lot to cover on the economy, and it's mostly bad news. Some viewers have sent me angry emails complaining that I only cover negative economic stories about China. Well, unfortunately, the most salient stories on the economic situation are currently negative. The economy is not in a good place, and as such, our coverage will reflect this. If things improve, then the coverage will reflect this as well. But for now, we must follow the actual situation on the ground. With that said, let's begin with updates related to China's years-long housing crisis. According to a new report published this week by research firm China Real Estate Information Corp, which is based in China, the number of foreclosed homes on the market in China rose more than 12% year-on-year in the first half of 2024, reflecting the growing struggle of homebuyers to repay home loans amid the prolonged real estate slump. A total of 202,000 foreclosed homes were listed for sale in the first 6 months of this year, according to the report. A person involved in the non-performing asset business in the southwestern metropolis of Chongqing told Chinese financial media outlet Caixin, quote, "Since 2023, people have increasingly failed to keep up with their mortgage payments, and some properties have gone into foreclosure." End quote. The outlet explains that the property downturn and the other headwinds facing China's economy, quote, have put enormous pressure on those who bought houses with a high amount of leverage in previous years. The risks of default could grow, therefore, further pushing up the supply of foreclosed properties. End quote. Another factor contributing to the foreclosures is developers failing to repay the money they borrowed to build the property in the first place. Of the foreclosed residential homes listed for sale in the first half of this year, over 5,000 were in Jiangzhou, capital of central China's Henan province, according to the China Real Estate Information Corp report. That number is up 43% from the same period last year. The average price of foreclosed homes sold nationwide during the January through June period fell 6.7% to $1,265 per square meter, according to the China Index Academy. Meanwhile, the general outlook remains bleak. According to a report from Bloomberg Intelligence published yesterday, at least 48 million homes in China have been sold before construction has been completed, quote, suggesting the country's property crisis won't be resolved anytime soon. End quote. The report points out that the figure, based on pre-sales data from 2015 through the first half of this year, is bigger than Germany's total housing stock in 2021. It presents a direct threat to developers' revenue because people could start avoiding pre-sales of new developments and instead buy completed or second-hand housing. The report observes, quote, China's property sector is facing multiple headwinds. Developers are suffering from liquidity shortage, despite the country's rescue package that included a 300 billion yuan, $42 billion, refunding program. New home residential sales slumped further in July by 19.7%. End quote. Adding to the challenges, the country's aging demographic means a shortage of construction workers. Migrant labor's average age rose to 43 in 2023 from 38 in 2014, with those above 50 jumping to 31% from 17%. None of these points we just covered will be surprising to regular viewers, of course. The report found a correlation between annual home completions and the number of construction workers, which hit its peak of 61 million in 2014 and has declined by 25% since. Okay, that is the housing sector. Let's now discuss, once again, the government bond market. We covered this topic in yesterday's video. What we covered today supplements that material. Sovereign yields fell across the curve on Wednesday morning, with those on 7-year bonds sliding the most since 2022. As UK-based The Financial Times explains, quote, beyond the wild swings is a widening gap between where officials believe yields should be and where debt traders see fair value as the economic clouds darken. While the former hopes to ensure financial stability by preventing a bond bubble, the latter wants to buy even more haven assets amid slumping stocks and falling property prices. End quote. The same day, yesterday, Wednesday, the central bank once again warned of the risks of too much demand for government bonds. As we discussed yesterday, this is a strange thing to complain about. A Wednesday commentary in the People's Bank of China's affiliated Financial News said, quote, "Since 2023, long-term bond yields have decreased by 60 basis points, showing a one-sided market trend, attracting a large inflow of funds and even some leveraged trading. Market analysts believe that the unilateral decline in long-term bond yields will accumulate significant financial risks. Once the market turns, rapid liquidation of leveraged positions will exacerbate the market's downward spiral and may even spread to other financial markets, creating systemic risks. The Silicon Valley Bank risk event in the US also provides insights for us." End quote. The piece threatens that authorities will crack down on any illegal actions that disrupt the bond market and threaten systemic risk. The article came, like we said, as traders rushed back into bonds after poor bank loan data fueled pessimism on the economy, and yields paired their drop after it was published. We will cover the loan data again shortly. Regulators in China hope to prevent a situation where a low long bond yield and pessimism about the future state of China's economy, and in turn expectations for further interest rate cuts, would reinforce each other, resulting in a downward spiral. As we discussed yesterday, however, the problem is it seems that confidence in other investment assets is collapsing. As Peking University finance professor Michael Pettis expressed in a piece published this week called "What is Driving China's Long-Dated Bonds," quote, "Banks and other fixed-income investors are not buying long-term government bonds out of perversity, but because the economy is struggling and better alternatives don't exist. This raises an obvious question. Will the regulators succeed in preventing banks from piling even more into long-dated government bonds and driving yields down further?" Another way of asking this question might be to consider how, if they are indeed prevented from buying the long-dated bonds, Chinese banks can manage their deposit inflows and the weak real demand for their funds. Unfortunately, in a slowing economy with rising savings, banks have little choice but to invest in low-risk, higher-yielding assets. One way or another, these savings have to show up somewhere, and the most likely and safest place is in long-dated government bonds. End quote. Next up, we have one more concerning economic update to cover, but just quickly, if you're getting some value from today's episode, don't forget to hit the like button. Liking, sharing and subscribing are the only ways in which this channel can grow and be shown to new people. Like I discussed yesterday, in recent weeks it seems that some people have been unsubscribed, so if you think you should be subscribed, maybe check this now. The algorithm doesn't seem to be too happy with the channel. I don't know why. Hopefully that will change. But for now, sharing, liking, and subscribing is the best way to ensure that it is shown to new people. Patreon and Buy Me a Coffee links are also in the description below for those who want to help keep the channel financially sustainable. It's just me making these episodes every day, but with your support, it's all worth it. Thank you so much, everybody, for the ongoing support. Okay, next up for the economy. In yesterday's video, we covered the concerning news that, according to official numbers, new yuan bank loans extended by Chinese banks were down nearly 88% in July, month-on-month, hitting a 15-year low. And China's bank loan gauge contracted for the first time in 19 years, as more debt was repaid than taken out. In a note published yesterday, Ren Ziping, a well-known analyst who previously served as chief economist at China Evergrande, who stepped down after correctly warning that the housing developer was heading for catastrophe, said China's situation had, quote, similarities with Japan's balance sheet recession in the 1990s. End quote. Economists have long debated whether China is facing a balance sheet recession, a concept Richard Koo, K-O-O, chief economist at Nomura Research, used to explain Japan's lost decade. His theory is families and businesses spooked by falling asset prices in Japan focused on clearing debts and stopped spending on the economy. The note contains a lot of themes we've been following closely on China Update for months now. I've translated some of the note, which we're now quoting selected excerpts from directly. In July, social financing and M2 slightly rebounded. M1 continued to hit new lows, and new RMB loans hit a new low. The central bank's interest rate cuts and government bond issuance provided some support, but financing demand remained weak. The current economic characteristics are noteworthy: high household savings, weak loan demand, low prices and asset prices, high real interest rates, and insufficient total demand, which bears some resemblance to Japan's balance sheet recession in the 1990s. The balance sheet recession theory posits that in extreme cases where household and corporate balance sheets are damaged, the goal of microeconomic entities shifts from profit maximization to debt minimization. They become risk-averse and debt-averse, repaying debts as soon as they have income and cash flow. While this decision is rational at the micro level, it creates a fallacy of composition at the macro level, leading to disappearing financial demand, shrinking credit, and declining output, resulting in a vicious cycle. Unlike cyclical recessions, balance sheet recessions are not easily addressed by conventional policies and require large-scale stimulus plans. Due to debt minimization and insufficient financing demand, market entities are insensitive to interest rate changes, falling into a liquidity trap where monetary policy is ineffective. Structural reforms can stimulate market vitality, but are slow to take effect, and supply-side reforms cannot replace demand-side stimulus. Fiscal policy can directly boost demand and is the main force to overcome a balance sheet recession. Currently, it is an important window for policy introduction and implementation. We should seize the golden September and silver October window to expand fiscal efforts. The first half of the year relied mainly on exports and manufacturing investment. With external demand declining in the second half, there is significant pressure to stabilize growth, necessitating strong stimulus policies to fill the financing gap of market entities, convert savings back into investment, promote moderate inflation, boost asset prices, and smooth economic operations. It is suggested to launch a large-scale economic stimulus plan led by new infrastructure, which will expand demand in the short term and create new engines for China's economy in the long term. At the same time, this should be accompanied by tax reductions and fee cuts to alleviate the burden on enterprises and residents, allowing them to recuperate. Government investment, represented by new infrastructure, is the best choice. New infrastructure includes artificial intelligence, vehicle road cloud integration, charging piles, battery swap stations, chip semiconductors, and other related infrastructure. These are public goods with strong positive externalities, which is also our successful experience in planning infrastructure ahead of time over the past 20 years. Here ends the direct quote. This final policy suggestion, of course, is in conflict with the views of some analysts who believe that China does not have the fiscal room for such stimulus, and that such a move will just further undermine efforts of much-needed structural reform. This debate will continue, of course, among top Chinese economists, analysts, policymakers, and non-Chinese observers. We will continue to follow the debate and China's policy direction as it goes forward here on China Update. Okay, that is today's episode. Thank you so much, everybody, for watching. Have a good Thursday. Weekend is almost here. I will see you all tomorrow.